Hey there, everyone. Happy Tuesday, January 13th. Welcome to Chart This with Dave Keller. My name is Dave Keller. Super happy to be with you here on the show. We're coming to you from boy, it was sunny earlier. Now it's kind of back to overcast Redmond, Washington. It's been rainy since I got back from Tampa. Literally, it was raining when I landed. It's been rainy pretty much consistently, kind of drizzly. And then today, it was so nice. I had an interview for the Market Misbehavior podcast. I interviewed top trader and unknown market wizard Jason Shapiro. It was an awesome discussion. It was so nice out. I actually did the intro from my driveway with the woods in the background. It was that nice. Boy, we're back to normal Redmond weather here. But hope you guys are doing well, staying happy, and in good weather inside your head, wherever you're at. Lots to talk about today. Late stage rally with the S&P makes it not too bad of a day. We were rotating lower through the course of the afternoon around 3:30 p.m. Eastern. It looked pretty ugly. And then a nice rally, a bunch of buyers coming in the last 30 minutes, pushing the S&P back to sort of mid-range for the day. And that was sort of the saving grace. But the major averages finishing lower, volatility pushing higher, not to warning signals just yet or, red flag levels, but certainly changing a bit. As always, here on the show, we're going to go through a quick market recap. We'll highlight some of the charts and movements we think you need to be aware of. We'll look at the heat map and focus on individual stocks, groups, themes, what sort of rotation we may be observing. And then we'll finish off with some of the charts that I've hand-selected through the course of the day today. As a reminder, your questions are encouraged and always welcome. Use the comments section on our YouTube channel. Please drop whatever questions come up through the course of our daily chart review here. We'd love to hear from you. Planning an old mailbag episode on Friday of this week, and we'd love to answer one of your questions on the show. All right, shall we talk about the major averages? Slight down day. That's how I would generally describe what happened here, but a choppy session, right? So this was not just the market drifting lower. I mean, look at these big price swings that you see through the course of the day today. Now, as you probably have picked up on if you watch this show more than a couple seconds, I'm not a day trader. That's not the time frame upon which I tend to focus. I'm primarily a position trader. I dabble in swing trading, and it's more for entertainment and for short-term plays, and it is to really build wealth. That's not the goal there. It's just to to think about the short-term kind of tactical time frame. But I don't go day trading. I don't really go in and out multiple times a day. And again, nothing wrong with that. If that's how you want to spend your time, that is fantastic. For me, I found quickly that it took way too much of my time and energy to do it well. However, if I was doing it, you want to feel like a 5-minute chart of the S&P with like a MACD indicator would be really good right about now. Maybe. Shall we take a look? Because, why not? I think so. So we'll do like an intraday chart. Yeah, so here's a 5-minute chart with the MACD indicator on the bottom. The reason why I'm saying a 5-minute chart is because, this is Monday session. Here's Tuesday. So look at Monday, kind of just like drifting higher through the course of the day, not really big swings. This is the 5-minute chart, and you can see the MACD indicator at the bottom. Look at the sell-off out of the open. And then after the bottom, you get the MACD buy signal here, and then we rotate higher. And then we rotate low. We almost pushed above yesterday's close, but did not, which is why that line, and if you wonder why a platform like Stock Charts defaults to showing yesterday's close, it's because this kind of thing happens more often than not, right? A lot of traders would sort of anchor to that previous close as an important level. So sure enough, we rallied right up to that point. Then we rotate lower. So something like MACD on an intraday basis, I mean, it's not the most perfect timing tool. It's not meant to pinpoint peaks and valleys, but as a short-term kind of lagging indicator, recognizing when the trend is reversing, really, really valuable. A day like today makes me feel like looking at the MACD on a 5-minute chart, looking at like the 5-period RSI or 9-period RSI in this time frame. The two of those together probably have some pretty good price swings to play, right? It would be an interesting day trading kind of day. Not where I tend to dabble, but it makes sense. Kind of what this looks like here. Obviously, quite a lot of movement here. The VIX did move up almost a full point. It finished just below 16. 16 is important because that basically means a VIX at 16 means the options market is pricing in about a 1% daily move in the S&P 500. It's about what that means. So above 16 means we're looking for a little more higher volatility. For me, a VIX above 20 is the level to watch. That's sort of the basic threshold. Below 20s, low vol, above 20 is high vol. We're still in a low volatility environment, but today certainly felt like there was more movement than we've seen in recent days. The mid-cap S&P 400 index, that is, was up slightly. Small caps down slightly. The major averages in the U.S. all down slightly. The Dow, though, the big underperformer, right? Here's the Dow down almost 1%. There's the NASDAQ, and the S&P almost flat for the day. So, Dow underperforming most of the other averages here, as we can see. All right, let's look at some other asset classes here very quickly. The 10-year yield finished around 417. The long bond around 483. Including the 5-year point. Those were all drifting a little bit lower. Short-term yields came up a little bit. The TLT, which is a bond ETF, up slightly. The dollar index moving higher again, about 7 pennies on the UUP, but that's, dollar index really starting to rotate higher. So we have kind of the situation where gold, crude oil, and the dollar all kind of pushing higher here. Here we can see the chart of the DBC, which is a commodity ETF. I stand corrected. Gold was up earlier in the day. I didn't check it right around the close. It did finish slightly lower. Silver prices held the zero line, up about 1.8%. Crude oil prices, one of the big gainers today. The USO was up about 2.5%, as was natural gas and gasoline futures, and in this case, the ETFs that we're tracking. Nice upswing in Bitcoin. 94,000 was that threshold we talked about on the chart of Bitcoin. We did push above there just here in the last couple hours. I am watching that chart closely. We see further improvement tomorrow. I'll probably start taking positions in a Bitcoin ETF or two to sort of play a potential upward move. That was the level we looked at, which would, for me, sort of signal a rotation out of this recent consolidation phase. We'll bring up that chart a little later in the chart review, but you can see all top 10 coins tracked on the stock charts platform in the green today. So nice upsurge in cryptocurrencies, kind of once again diverging from what we've seen with the equity indexes, not necessarily doing the same thing these days. All right, looking at the 11 S&P sectors, energy up 1.4%. Stronger crude oil prices usually mean stronger energy stocks. While a lot of those charts, I would argue, still not great. Certainly seeing that at the top of the leaderboard today. Consumer staples, one of the more defensive sectors, number 2, that's 1.2%. Number 3 was real estate. Number 4 was utilities. Those are 3 of the most defensive sectors, certainly. So kind of defense over offense, a general theme in today's market. On the downside, financials feeling the pain. Financials are kicking off Q4 earnings, that is. This week, we had JPMorgan disappointing. We'll show you that chart along with other charts here in a few moments. You will see, some financial stocks actually doing okay, particularly some of the regional banks, but the big money center banks struggling today. A lot more earnings to digest in the days to come, but financials will be in focus. Starting next week, we'll focus on a lot of other sectors, but that's where we're going to get started here. Communication services and healthcare are the next 2 from the bottom of the list. Looking at breadth, very much a neutral day here. We can see on the New York Composite Index, 51% of stocks were up, 46% were down. That's basically a neutral reading. You can see the neutral shading on here. The S&P 500, slightly better, but not much, 52 to 48%. Small caps, probably the worst breadth, it looks like, 57% down to 43% up. These are still pretty kind of neutral readings. It was a neutral day in terms of the close. It was a neutral day in terms of breadth. This is pretty much a wait and see day, I would say, overall. All right, checking in on the mega cap growth stocks, another day where you get a real spread from the charts that are working and the charts that are not. At the top of the leaderboard, I would say, without argument, the strongest of the Magnificent 7 charts remains Alphabet. It is the most extended versus its 200-day moving average. It is the only one, I would argue, in a clear uptrend, the only one at or near all-time highs. Amazon's a little bit close, but down pretty good today. So Alphabet up another 1.25%. Netflix, which has been the absolute dog of this list, up 1%. Then some of the semiconductors that have been lagging the rest of semis, Broadcom and NVIDIA, both up slightly, less than 1%. On the downside, Meta continuing to be a pretty ugly chart, continued to pull back after an attempt to break above a key Fibonacci level we've covered here on the show, down 1.7%, down 1.6% for Amazon. And Microsoft, along with Apple, 2 of the underwhelming technology names, down 1.4%. So, I mean, again, just today, I think is a perfect representation of what we've seen recently with the Magnificent Seven. It is a mixed bag. I mean, there have been times when it feels like they're all going up. There have been times when they're kind of all going down, not in a while. This is one of those times where it's very much a stock picking exercise, right? Some really good charts, some really ugly charts, some decidedly neutral, like a Meta is a neutral chart. It's really range bound in that kind of yellow light region if you use the traffic light technique that we've talked about. All right, we'll continue on looking at the heat map. I do want to remind you, we appreciate you so much watching the show as always. I appreciate you doing so. I appreciate you sharing this with others, anyone that you know that is analyzing the markets and could benefit from some better decision making, some improved market awareness. Please let them know that the show is here and that they can find it on our YouTube channel. Drop a question in our comment section when you have a moment, because the mailbag can always use another fantastic question from a viewer like you. All right, looking at the heat map here, we're going to start right in the middle. JPMorgan, Visa, and Mastercard, three of the largest names in the XLF, all in the red. As a matter of fact, all top 10 of the financial sector S&P 500 members are down today. Those three, JPMorgan, Visa, Mastercard, down the most. JPMorgan on earnings, Visa and Mastercard, these are the credit card companies kind of struggling after comments over the weekend. But all of them, top 10 stocks down. You have to get down to BK, Bank of New York Mellon, which made a new all-time high today. So talk about a divergence from the rest of the space. But again, the general theme in financials today, not particularly good. And it wasn't just one of them, right? T. Rowe Price, a pretty compelling chart, threatening a breakout, threatening a new 52-week high, kind of stalling out and pulling back about 3% today. AJG is one of the insurance companies, had a nice rotation higher, kind of pulling back sort of anything and everything. There are a couple names that were actually up today, but not many. The general theme here is down. Also seeing quite a bit of red in the technology sector. I mentioned NVIDIA and Broadcom. Those are two semiconductor stocks that have really just not been participating in the upswing in semiconductors. The SMH, the semiconductor ETF, is outperforming the S&P here in January, but stocks like Broadcom and NVIDIA have not really been great examples of that uptrend. Even today, you have AMD bouncing off of support. You have Lam Research, LRCX, pulling back after making a previous all-time high. You have Intel, that is, making a new all-time high, following through on recent upswings. You have Applied Material pulling back down about 0.8% after making a new all-time high. So kind of a mixed bag in the semiconductor space, a little of everything, some strong, some weak, some in the middle. Very, very much a choppy session here and a choppy January so far in a lot of ways. So if those are the areas of the market that are struggling, what's starting to work? Look at all the green in industrials. We've highlighted names like Boeing making new all-time highs. Look at all the green in consumer staples. Walmart made a new 52-week high today. Not bad, right, for the big box retailers. Energy stocks with crude oil prices doing quite well today. Energy generally moving higher. Very few of these in what I would describe as very constructive technical configurations. A lot of these are more range bound and still have quite a bit to prove, but a day like today certainly helps. Then you've got like REITs and utilities. So the more defensive sectors, which have generally been struggling here recently, a lot of this having some pretty good days. Now, this is just one day. So I think, again, for me, the heat map, what we show on the show here is just a way to check in on what happened today. The reason why I moved the mouse over and focus a lot on those little charts is because context matters, right? JPMorgan down 4.2% is just part of the story. What that means relative to the fact that it recently made new all-time highs, the fact that for the last 3 months, it's been a strong outperformer, the fact that it's had a nice breakout after consolidating in the fourth quarter. Those are all things that the chart can help us understand, right? So the daily movements on the heat map just tell you the most recent data point. We want to connect today's action with the other data points to see what today means relative to its context, right? And so I think that's what I tried to do, just doing the little preview chart, again, with more time. And if I wasn't trying to get through a ton of charts and stocks for you in about 30 minutes, I would spend more time and look at the individual charts, look at the daily chart, the weekly chart, and really start to understand more about the trends, the momentum, and potential inflection points as always. But that's why I'm focusing on those little preview charts, just to think about what today's move means relative to the longer term trend. All right, we're going to get to some charts here in a moment. I do want to remind you, If you have not taken our free behavioral investing course, why not do it today? You can go to marketmissbehavior.com/free course or scan the QR code that you see beautifully illustrated in that coffee cup that I created a while back. That'll take you to our free course called The 5 Modes of Mindful Investors. We'll talk to you about some of the ways that we have developed over our career in coaching successful investors and working with successful money managers and hedge fund traders, and just thinking about how you can apply them to your own investing process, to your own relationships with clients, how you can get out of your own way, make better decisions, and manage risk. Again, go to marketmissbehavior.com/free course. Scan the QR code that you see on your screen. Either way will get you to that free course. I would encourage you to check it out. Hopefully it just makes you think about how you think about the markets, as I like to say. All right, so we check in on the little traffic light sort of setup here. So earlier in the day, right? So I usually start preparing for the show first thing in the morning. Moment I sort of I usually look at the markets around 7 a.m. Pacific time, which is around 10 a.m. Pacific. That means we're in about 30 minutes. I can just check in on what's happened out of the open. I can start looking at charts and movements and start creating content, writing articles, reaching out to premium members, answering questions, doing all that good stuff. And through the course of the day, I'm randomly when I'm doing something and I find a chart that's interesting, I kind of save it to a list, and that turns into the list of charts that we review on the show every day. Earlier in the day, about an hour before the close, this looked like a big bearish pattern, what looked to be kind of a bearish harami pattern, or what could have ended up being a bearish engulfing pattern. It had that look. But the late stage rally, right, that rally in the last 30 minutes of trading really changed the configuration. So it is technically a bearish inside day, but not like a high conviction candle pattern or bar chart pattern that I think is super important. It was just a down day. We traded below the open and closed below yesterday's close. But overall, this is pretty much a similar range to what we've seen Monday and really last Friday. The last Friday's move higher sort of has stalled out, and now we're sort of sitting up in this green shaded area, which is our part of our traffic light technique, kind of the bullish range, right? Anything above 6,900, I would say, is pretty constructive here. What I'm looking for is, will the S&P remain above the 6,900 level this week? Will we also remain above a trend line using the major lows in November and December? That's not too far below today's low. So I think holding that would be pretty key. The 21-day exponential moving average and even the 50-day moving average not too far above those below those levels. Anything down to 65.50, I would say, is still part of a kind of normal noise within a consolidation phase. Anything below 65.50, I would start being pretty concerned about the general market trend. But for now, higher highs, higher lows are bullish. Whether you call this a rising in an uptrend of higher highs and higher lows, which is how I generally tend to refer to it, or if you call this a rising wedge with higher lows and higher highs, where we're kind of converging down the road here. In either case, the outcome is the same from a technical perspective. As long as we hold this lower trend line, it's still fine. But if we would break below that trend line, that's where you start to get concerned. So keep an eye on this one as we get a lot of earnings in the coming days. Could be an interesting sign of things to come. Crude oil prices, commodities, very much on the list here. Gold was slightly lower, silver up, but the story, I would say, in the commodity space was the strength in crude oil. Crude oil finished around $61 a barrel. That's the highest level we've seen really in the last 6 weeks. So you got to go back to kind of late October for anything really above there. And honestly, even back to like August and September was the last time we were in the 60s for any extended period of time here. The 200-day moving average is once again getting pretty close. We've had a couple attempts to get above the 200-day, most recently in late September. We didn't even make it up there. Here in late July, we made it up for a couple days before rotating lower. The 21-day has been a repellent for crude oil. We'll see if there's enough momentum to push through there. We are above the 50-day. That's good. We'd stalled out there a number of times. We are making a higher low and now a higher high. That's encouraging. The RSI is pushing above 60. That's bullish. I think seeing a sustained move above the 200-day moving average and holding that breakout would be even better. Then and only then would I say, wow, crude oil is strong enough that I think energy stocks could be a pretty decent bet. We're not quite there yet. That's what I'd be watching for on that particular chart. Bitcoin earlier in the day hit our trigger. We had an alert set for when Bitcoin pushes above 94,000. That triggered earlier in the equity trading session as it pushed above there. I mean, at this point, if you look at the chart, I would argue it's still kind of testing resistance. Here's the swing highs in December. There's the swing high from about a week and a half ago in early January. We're kind of right up to that point. So we've traded up to this level a number of times. And anytime you have a clear resistance level like that, for me, the game is just being patient and waiting for that breakout above the resistance level. It's not quite there. If we fail here, that's where you have to look back at some of these previous lows. Take a trend line off of these lows. It's similar to the S&P. We're not far from breaking down below that, breaking below the 50-day. That would be a pretty negative outcome, obviously. Holding this in the 90,000 level and breaking above 94. I think that's the bull case I'd be looking for, at which point I'll let you know. I'll probably start adding a position in a Bitcoin ETF of my choice. But for now, we're sort of right at that key moment. The momentum is good. So I like the fact that we're pushing above an RSI of 60. That's usually an encouraging sign. But the question is, do we sustain that breakout? Boy, financials, a lot of financials lower today. I highlighted some of the ones like First Visa and Mastercard. These have been under pressure, obviously, since this weekend when President Trump talked about limiting the interest rate that credit card companies could use in 2026. Question remains what sort of legal path there would be to actually doing that, and if that's a policy change that he could actually make. Hasn't stopped him before. I'm just trying to, saying bold things and seeing what happens, I guess. So that's what we're observing here. Visa, what's interesting is going into this week's sell-off, we had a bit of a bearish momentum divergence. Look at the higher highs late December into early January. We're overbought on the first one. We're not overbought on that second one. That's a short-term bearish divergence. We could see a number of these, like here back in May and June going into that peak. I mean, really, it's not a perfect one, but I would say here in January and February of last year, you had that one. Even back here in like November and December of 24, we had higher highs on weaker momentum. Those all ended up, leading to some pullback, in some cases a short-term pullback before a renewed uptrend, or something more significant of a drawdown. But so bearish divergence has now led into a rotation lower, or now undercut the 200-day, undercut the swing low from year end. Now we're watching that key support 320, 325. That's been a major low in the fourth quarter. Do we hold that? The RSI is already in the bearish reading below 40. That is. So suggesting weakness over strength here. We'll see if buyers come in at these previous swing lows. And if not, I think Visa becomes a very uncomfortable chart very, very quickly. Similar, kind of different in some ways for Mastercard, but a similar general theme there, testing support. JPMorgan rotating lower after earnings today. They reported, I think, before the open today. JPM down about 4%. It was down a little bit. It looked like it may end up going lower, but 4.2% will do it for the close. Still not bad, right? We're right at the 50-day moving average. We've gone slightly below there a couple times here in the last 6 months. Every one of those times have been very buyable dips. Note what was really important here in October and November. The RSI hold almost exactly at 40. That happened again in early December as we tested the 50-day yet again. Here we are back to the 50-day. We're back down to that RSI 40 level. I watch momentum because what's happened is the trend has been positive. And Connie Brown, the late Connie Brown, shared with me and many others through her books and her presentations, when you have a big uptrend phase, the whole range of the RSI moves up. So you want to think of overbought as more like 70 to 80. You want to think of oversold as more like 30 to 40, because the whole range kind of bumps higher, which also means, I would say, is if instead of holding 40, if it breaks below 40, that's often a sign that whatever bullish phase we were observing is no longer in place. And now we're in a new bearish phase. And then you look for it to rotate back into a bullish range as an all clear signal. So we're very, very close. We're testing support. The RSI is right at the lower end of where it should be if this is still a bull market phase. If JPMorgan breaks further, if we fail to hold support, watch the 200-day moving average right around 287 to 290. Also watch that RSI 40 level. Pretty crucial. Now, while JPMorgan and some of the other larger banks are breaking down, regional banks like BK doing pretty good. BK was another earnings name today, but up 1.9%, making yet another new all-time high. The good thing for names like Bank of New York Mellon, this is the biggest, I believe it's the biggest regional bank listed in the U.S. It's definitely one of the top three. I would guess probably the top one at 86 billion market cap. That's pretty big. for a regional bank. Regardless, it's still in a clear uptrend phase, right? Higher highs, higher lows, moving averages going higher. Bit of a bearish momentum divergence, as you may note down here with the RSI indicator, but overall pretty good and outperforming consistently over the last year and a half. That's what that bottom panel indicates to you. The kicker for Bank of New York Mellon is that the yield curve continues to have a normal shape, right? The yield curve continues to steepen generally. Has been the trend here over the last couple months. And a steeper yield curve, a more normal shaped yield curve should be great news for regional banks. We'll see if that's reflected in their earnings, particularly in their guidance. We'll see if that's reflected in the charts. Names like BK have been in an uptrend for quite some time. Look how long it's been outperforming, but innocent until proven guilty, right? Wait for the chart to tell you it's no longer good. Chart's still good by my reading. Speaking of good charts getting better, let's talk about two consumer names, two apparel retailers doing just fine here. Here's Ross Stores, ROST, long and strong up and to the right. And again, I got questions on Ross Stores back here. Is it too late? Did I miss the breakout? And I love to reflect on charts like this where the new 52-week high was just the beginning. Years ago, when I was just getting started, this is like early 2000s, I remember talking to hedge fund traders who are really more mean reversion type of traders. And they would say the new highs list is where you want to be fading it because they were really more swing traders. They would be looking for breakouts and bet on that mean reversion, right? A big break and then that first big pullback down. And that's what they were trying to play. Then I started working with more long-term investors. I eventually ended up at Fidelity up in Boston. And I found the new highs list was like a frequent list to review to look for strength. I remember reading the IBD, the Investors Business Daily, when it was a print newspaper. Every day I'd buy it at the same newsstand that was at 58th and Madison, if I remember right, 59th and Madison, one of those. I'd buy the newspaper from the same guy every morning. I would take the Wall Street Journal and the IBD. I would get my coffee and bacon, egg, and cheese on a roll, and I would go up to the conference room in Bloomberg, and I would go through those papers, and I would review those charts. And what I learned from looking at IBD every day for a number of years, there was always a chart going up. There was some, even if the market was struggling, even if there were all these like macro questionable things, inflation, interest rates, whatever, some chart somewhere was breaking out. I think that's what I have in the back of my mind when I sign off the show with, it's always a good time to own good charts because good charts are always there. You just have to find them. Ross Stores, regardless of what you think, how scary you think the world is or how challenging you think the environment is for the retail consumer, Ross Stores is going up. Here's Ulta Beauty also going up. This is in the specialty retailer group. But look at the chart of Ulta. Right? We had the gap higher. This was on Q3 earnings back here in December, gapping above resistance and then running higher. Both of those charts in an uptrend phase, higher highs and higher lows. Both of those charts, the moving averages are sloping higher. And because of that strength, both of these stocks are seeing consistent outperformance. Those are the types of charts I like to always be on the lookout for. They're out there. Keep looking for those names. And again, let the chart tell you when it doesn't deserve a place in your portfolio any longer. Final chart for the show here. We'll look at CF Industries Holdings, ticker CF. This is in the materials sector. It's a specialty chemical name. I want to highlight this one because remember, one of the great benefits, I think, of technical analysis, it helps you differentiate from interesting charts from actionable charts. Anytime I use that word, that adjective actionable, that means not just it's like a good chart. Like Ross Stores, is that an actionable chart? Like, no, right? It's in an uptrend. There's not any particular moment right here where I say this is an actionable moment. There's something seeing on the chart right now which tells you today's the day. Pulling back to an ascending 21-day exponential moving average. That's when I would say Ross Stores or whatever chart you're looking at is more of an actionable chart. It's in an uptrend and it's pulling back to a level of short-term support. That could be a really good opportunity to ride the next leg high, right? That's the difference between a good chart, a compelling chart, an interesting chart, and an actionable chart, right? Something's happening today. I would argue a chart like CF is right around that actionable sort of label. And here's why. We're going back to the April low and the June high. If we use that to create what I call a Fibonacci framework, where we use that as the low and as the high, and then we use the Fibonacci levels to identify key levels of support. Look at how well CF followed that Fibonacci framework. Here's the low in June, hitting the 38.2% level. Here's the low in August, right around the 61.8% level. You see a number of times where we kind of trade slightly above or below, kind of rotate around those levels. Fast forwarding here in November, we broke below that final Fibonacci support level. However, that then became resistance. We ended up stalling out around 76. We didn't get much lower. Then we had a number of tests to that 61.8% level from below. When I see that kind of pattern, I just sort of wait for that break above. And we got that last week, finally breaking above that 61.8% retracement, which also ended up getting us above the 50-day moving average. Now we're back up to the 200-day. Now we're back up to the 50% level. And I think of it as an if-then statement. If we can get above 85 and clear that level of resistance, then I would expect us to get maybe in the 89, 92 range, right up into this area, which would be the 38.2% retracement. Also, these swing highs from September and October. So I think it's helpful in your process to be scanning for stocks that are good charts, scanning for charts that are clearly bad charts. But then you have these actionable ones where today's not the day, right? It's not the day where I'm saying CF is a really good breakout, but I can see exactly where I'd want to set an alert. I can see what I might need to see to validate a breakout. It's a bit of a shooting star candle, similar to what we saw on Friday. So maybe we have to wait another day or two before that breakout, but I'm watching for a break above 84.50, 85 to clear resistance. And I would argue signal a bullish breakout for materials name CF. Folks, that'll do it for today. There's your quick market review of some breakdown of some heat map action and also some important charts with some technical analysis, tips, and tricks along the way. If you like the show, thanks so much for sharing it with others. Appreciate it. It means a lot. And for sure, appreciate your feedback and your comments. Drop a question in our comments section on our YouTube channel. We may feature that in our Friday episode. In the meantime, have a great evening. And remember, it's always a good time to own good charts. Take care, folks.